This is the story of the CANSLIM system, one of the most complete, objective, and historically validated frameworks for growth stock investing ever created. This is not a story about abstract theories or gut feelings. It is the story of how O'Neill, acting as a market scientist, reverse-engineered the characteristics of success. He did not invent his rules from thin air. He discovered them by conducting a massive multi-decade study of the market's greatest winning stocks, what he termed supers. He sought to create a definitive, quantifiable profile of a winner, a checklist of common traits that these elite companies exhibited before they began their massive price doubling and tripling advances. The result was CANSLIM, a 7-part system that is a masterclass in fusing rigorous fundamental analysis with precise technical timing. In this first part of our deep dive, we will deconstruct the first 3 and arguably most important fundamental pillars of this system: the letters C, A, and N. This is the foundation for finding a company with the raw power to become a true market leader. To understand the genesis of the CANSLIM system, one must first understand the unique, data-driven mindset of its creator. William J. O'Neill began his career as a stockbroker for Hayden Stone & Company in 1958. From the very beginning, he approached the market not as an artist but as a scientist. While his colleagues were relying on intuition, tips, and subjective analysis, O'Neill was obsessed with objective, verifiable data. He was one of the first investors to purchase a computer to aid in his research, using its power to analyze market data on a scale that was previously impossible. He was not interested in what should work in theory. He was only interested in what had worked in reality. This empirical mindset led him to undertake a landmark historical study that would become the foundation of his entire career. He embarked on a meticulous multi-decade analysis of the market's greatest winning stocks, from the 1880s through the modern era. He studied hundreds of superstocks, companies that had delivered spectacular, life-changing returns. His goal was to identify the specific, quantifiable characteristics that these companies shared before they made their monumental price moves. He was not looking at them after they had become famous blue chips. He was looking at their financial and technical profile when they were still emerging, often overlooked growth companies. Through this exhaustive research, he discovered that the greatest winners of all time were not a random collection of different types of companies. They shared a distinct and surprisingly consistent set of traits. They were not cigar-butt value stocks, nor were they speculative companies with no earnings. They were, almost without exception, innovative companies with powerful, accelerating earnings growth, strong institutional backing, and specific bullish chart patterns. The CANSLIM system was born directly from this data. It is not a theory of what O'Neill thinks should work. It is a codification of what his historical research proved has worked, time and time again. The first and most critical letter in the CANSLIM acronym is C, which stands for Current Quarterly Earnings Per Share. This is the system's primary and most powerful fundamental filter. O'Neill's research showed that the vast majority of superstocks, typically 90% of them, exhibited a dramatic and significant increase in their recent quarterly earnings per share right before they began their major price advance. The rule he established was to look for companies with a year-over-year increase in quarterly EPS of at least 25 to 30%. However, he stressed that this was a minimum, and that truly exceptional companies would often be showing growth of 50%, 100%, or even more. The logic behind this rule is the principle of acceleration. A company that has been growing at a steady 15% for years is a good company, but it is unlikely to become a superstock. O'Neill was looking for a major inflection point, a sign that a company was shifting into a new higher gear of growth. The most powerful signal of this was not just high growth, but accelerating growth. For example, a company whose earnings growth went from 20% to 40% to 70% over 3 consecutive quarters was sending an unmistakable signal that something profoundly positive was happening with its business. This acceleration is what attracts the attention of large institutional investors, and their massive buying is the fuel that powers a stock's great advance. O'Neill was adamant that an investor must not be afraid of a stock that has already moved up in price after such a report. For the traditional value investor, such a stock might look expensive. For O'Neill, this strength was a powerful buy signal, a confirmation that the market was beginning to recognize a fundamental change in the company's prospects. However, O'Neill was not just looking at the headline earnings number. He insisted on digging deeper to ensure the quality and sustainability of the growth. He taught investors to also look for a corresponding surge in quarterly sales. He required sales to be accelerating or at least growing by a strong 25% or more. This was a critical cross-check. A company can, for a short period, boost its earnings through aggressive cost-cutting, asset sales, or other one-time financial maneuvers. But a company cannot fake sales growth. Strong and accelerating sales are the definitive proof that the company's products or services are in high demand and that its business has real, underlying momentum. The combination of both explosive earnings growth and strong sales growth was the 1-2 punch that O'Neill looked for as the primary sign of a potential superstock. The second letter in the acronym A stands for annual earnings growth. This is the second fundamental pillar of the system, designed to ensure that the company is not just a one-quarter wonder. While the C identifies the immediate spark of acceleration, the A confirms the long-term quality and durability of the business. O'Neill's research showed that the greatest winning stocks had a long and consistent track record of strong annual growth long before they became household names. His rule was to look for companies that had grown their annual earnings per share at a rate of at least 25% for each of the past 3 to 5 years. The logic here is that a single great quarter can be a fluke, the result of a single large contract or a temporary industry trend. But a company that can consistently grow its profits at a high rate year after year has proven that it possesses a powerful and sustainable competitive advantage. This consistent growth is evidence of a superior business model, excellent management, and a product or service that has enduring value. To further gauge the quality of a company, O'Neill also used 2 other key annual metrics. The first was return on equity, or ROE. He looked for companies with an ROE of 17% or more. The ROE is a measure of how efficiently a company's management is using its shareholders' capital to generate profits. A consistently high ROE is a hallmark of a well-managed, highly profitable enterprise. The second metric was profit margins. He wanted to see high and, ideally, expanding pre-tax and after-tax profit margins. A company that can maintain or increase its margins is a sign that it has a strong competitive moat and significant pricing power in its industry. The C and the A work together as a powerful dual filter. The A identifies a universe of fundamentally superior, proven, and well-managed companies. The C then acts as a timing tool, singling out the companies from that elite group that are experiencing a dramatic, positive, and fundamental change in their business right now. This combination is the key to his fundamental screening process, a method for finding the best companies at the exact moment they are beginning to accelerate. The third letter, N, stands for new product, new management, new highs. This is the catalyst principle. O'Neill's historical research revealed that almost every great stock market winner, every superstock, was driven by something new and exciting. This new element was the powerful catalyst that propelled the company to a new level of growth and profitability, capturing the attention of both the public and institutional investors. The most common and powerful N is a new product or service. A company that develops a truly revolutionary product can create an entirely new market or completely dominate an existing one. This creates the potential for the kind of explosive earnings and sales growth that defines a superstock. O'Neill's historical study was filled with examples. Apple with the first personal computer and later the iPhone, iOmega with its zip drive in the 1990s, Cisco Systems with the routers that built the Internet. In each case, a groundbreaking new product was the engine of the company's spectacular growth and its stock's monumental advance. A second type of catalyst is new management. Sometimes a great company with valuable assets or a strong brand can be held back by years of mediocre or complacent leadership. A change at the top, the arrival of a new dynamic CEO, can be a powerful catalyst for unlocking the company's true potential. New management can bring fresh ideas, cut unnecessary costs, sell off unprofitable divisions, and re-energize the corporate culture. O'Neill taught investors to be on the lookout for these situations, as they often precede a major turnaround in a company's fortunes. A third catalyst can be new industry conditions. Sometimes a change in government regulation, a major technological breakthrough that benefits an entire sector, or a shift in the broad economic climate can create a powerful tailwind for a whole group of companies. An investor who correctly identifies these new industry-wide conditions can find multiple winning stocks within that single theme. The final and most controversial, N, is a new high in the stock's price. This is the part of O'Neill's methodology that is most at odds with conventional investment wisdom. The average investor is taught to buy low, sell high, and is often terrified of buying a stock that is trading at or near its 52-week high, fearing that they are buying the top. O'Neill's research proved that this mindset is completely wrong. He found that the vast majority of superstocks broke out to new highs before they began their greatest advances. For him, a new high was not a signal of risk, but the ultimate sign of strength. It was a clear indication that the company had powerful momentum and was in high demand. A stock making a new high has no overhead resistance, no disgruntled prior buyers who are waiting to sell their shares to get back to even. Every single person who owns the stock has a profit, which creates a positive psychological environment. O'Neill was adamant that the goal is not to buy cheap stocks, but to buy the best stocks at the right time, and the right time is often just as the stock is emerging from a sound price consolidation, or base, and breaking out into new high ground. This brings us to one of the most fundamental debates in investing. Do you agree with William O'Neill's philosophy of buying stocks as they are breaking out to new 52-week highs, a sign of proven strength? Or do you find it psychologically difficult to buy what appears to be expensive, preferring to look for bargains among stocks that have fallen in price? Let us know your view in the comments. For O'Neill, the answer was clear and backed by decades of data. The new high was the final catalyst, the technical confirmation that a company with powerful fundamental characteristics was now ready to make its major move. These first three letters, the C, the A, and the N, form the complete fundamental framework for identifying the what, the elite group of innovative companies with the explosive earnings power that is the prerequisite for becoming a market superstar. But identifying a great company is only the first step. The next, and equally critical, part of the process is knowing when to buy it, who else is buying it, and how to use the overall market trend as your ultimate guide. That is the art of the SLIM, and we will deconstruct it in part 2. This second part of our masterclass is dedicated to the second half of the equation. We will now move from the fundamentals of the company to the technicals of the stock and the broader market. We will dissect the remaining 4 letters of the acronym, the S, L, I, and M, and the disciplined cell rules that complete the system. This is O'Neill's framework for answering the equally critical questions of when to buy, who else is buying, and when the overall market is providing a tailwind for success. This is the art and science of timing, selection, and, most importantly, risk management. This is how the what is translated into the when. The 4th letter in the CANSLIM acronym is S, which stands for supply and demand. This principle takes us to the very heart of what makes a stock price move. O'Neill understood, as all great market operators do, that the price of any security is ultimately determined by the raw interplay of supply and demand. The S in his system is a set of tools for analyzing this dynamic, specifically by looking for situations where the available supply of a stock is relatively small and the demand from large institutional buyers is overwhelmingly large. This creates an explosive combination that can lead to rapid price appreciation. The supply side of the equation focuses on the number of shares available for public trading, a figure known as the float. O'Neill's historical research revealed a fascinating pattern. Many of the greatest winning stocks of all time were not massive blue-chip companies with billions of shares outstanding. They were often smaller, younger companies with a much smaller number of shares in their float. The logic behind this is a simple matter of physics. It takes far more energy or buying power to move a massive object than it does to move a small one. A company with a 500 million share float might require billions of dollars of institutional buying to make a significant price move. A company with a 25 million share float, however, can see its price soar with a much smaller amount of focused, aggressive buying. O'Neill was not exclusively looking for small-cap stocks, but he recognized that a smaller float could act as a powerful accelerant during a period of high demand. He also looked at the behavior of insiders. A company with significant insider ownership was a positive sign, as it meant that management's interests were aligned with shareholders, and it also reduced the number of shares available for public trading, further tightening the supply. The other side of the equation is demand, and for a major price move to occur, that demand must come from the only players with enough capital to create it: institutional investors like mutual funds, pension funds, and hedge funds. The S is therefore also about learning to read the footprints of this big money. O'Neill taught his students to become detectives, to look for the subtle but clear signs of institutional accumulation on a stock's price and volume chart. The most obvious signal is a massive volume spike. He would look for days or weeks where a stock's trading volume was 50%, 100%, or even several 100% above its 50-day average. A surge in volume like this, especially when accompanied by a strong upward move in price, is the unmistakable signature of institutional buying. It is the sound of the market's elephants getting into the pool. He also refined this analysis by looking at the balance of accumulation days versus distribution days. An accumulation day is a day where the stock closes up on higher volume than the previous day, a sign of institutional buying. A distribution day is a day where the stock closes down on higher volume, a sign of institutional selling. A healthy, emerging leader should show a clear pattern of more accumulation days than distribution days in the weeks leading up to its breakout. This entire analysis of supply and demand is what allows an investor to see that a stock is under accumulation by the market's most powerful players before its big move has even begun. The fifth letter, L, stands for leader or laggard. This is one of O'Neill's most powerful and uncompromising principles. His rule was absolute: always buy the true market leader and never settle for the laggard. In any given industry, there are dozens of companies. Most investors, driven by a desire to find a bargain, are often drawn to the beaten-down, cheaper stocks in a hot industry group, the laggards. They see the leading stock, which has already moved up significantly in price, and think, "I've missed it. It's too expensive. I'll buy its cheaper competitor instead." O'Neill's research proved that this is a fatal strategic error. His historical analysis showed, time and time again, that the stock that is the first to break out to new highs, the one that shows the most powerful price momentum, is almost always the one that goes on to become the biggest winner. The laggards, the sympathy plays, almost always underperform or fail entirely. To remove all subjectivity from this process, O'Neill developed a proprietary quantitative tool, the IBD Relative Strength RS rating. This is a simple, powerful number ranging from 1 to 99 that measures a stock's price performance over the last 12 months compared to all other stocks in the market. A stock with an RS rating of 90 means that it has outperformed 90% of all other stocks over the past year. It is a pure, objective measure of a stock's momentum and leadership characteristics. O'Neill's rule was to only consider buying stocks with an RS rating of 80 or higher, and ideally, those with a rating above 90. He was not interested in stocks that were just starting to turn around. He wanted to buy the proven winners, the ones that were already demonstrating their superiority. The psychology of this rule is deeply counterintuitive. It requires an investor to overcome the natural human instinct to look for bargains. Buying a stock that is already at a new 52-week high and has one of the highest RS ratings in the market feels, to many, like buying at the top. But O'Neill proved that this is where the greatest opportunities are found. The market leaders are leaders for a reason. They invariably possess the best earnings growth, the most innovative products, the strongest management, and, as we will see, the most powerful institutional backing. For O'Neill, strength begets more strength. The L in his system is a powerful filter that forces the investor to focus exclusively on this elite group of market-leading stocks, the A-plus players, and to ignore the vast universe of mediocre B and C grade companies. He also stressed the importance of industry group strength. It was not enough to buy a leading stock. One had to buy a leading stock in a leading industry group. He knew that a powerful industry trend could act as a massive tailwind, lifting all the stocks in that group. The sixth letter, I, stands for institutional sponsorship. This principle is the logical extension of the S and the L. It takes big demand to fuel a superstocks advance, and that demand must come from institutional investors. The I in the system is a final quality check to confirm that the smart money is already on board. O'Neill taught his students to investigate the ownership of a potential stock. He wanted to see a reasonable number of institutional owners, particularly mutual funds, as this provided a base of support for the stock and validated its fundamental story. However, his approach to institutional sponsorship was highly nuanced. It was a philosophy of quality over quantity. He was not just looking for any institutional ownership. He was looking for sponsorship by high-quality, well-performing institutions. He would cross-reference a stock's ownership with the list of the best-performing mutual funds over the past few years. If a company was owned by several of these top-tier funds, it was a massive vote of confidence from the market's most skilled professional managers. It was a sign that other serious, successful researchers had done their own due diligence and had come to the same bullish conclusion. But here, O'Neill introduced a crucial paradox. While some institutional ownership is good, too much is a major warning sign. This is the concept of a stock being over-owned. If a company's stock is already held by hundreds of different institutions, and it makes up a large position in many of their portfolios, it creates a dangerous situation. First, it means that the big money has likely already been made. There are very few large potential buyers left to drive the stock significantly higher. The buying power is exhausted. Second, and more dangerously, it creates a situation of crowded ownership. If the company should stumble and report a single bad quarter, these hundreds of institutions may all try to sell their massive positions at the same time. This can create a torrent of supply that can crush a stock's price in a matter of days. O'Neill, therefore, looked for a sweet spot. He wanted to see a small but growing number of high-quality institutional sponsors. This indicated that the smart money was getting in, but that the story was still in its early innings, with plenty of room for more big funds to pile in and drive the price higher in the future. The seventh and final letter, M, stands for market direction. For William O'Neill, this was the most important letter of all. He believed that no matter how perfect a stock's Kansley profile was, it was unlikely to succeed if the overall market was in a downtrend. His research showed that 3 out of 4 stocks, even the very best ones, will follow the general direction of the market. Trying to make money on the long side during a primary bear market is, in his view, like trying to swim against a powerful tide. It is an exhausting and ultimately losing battle. The M in his system is a set of tools for determining the health of the overall market, and it acts as the final and most important filter for any investment decision. O'Neill's method for determining the market's direction was not based on opinion or economic forecasting. It was based on a direct daily interpretation of the price and volume action of the major market indexes, primarily the S&P 500 and the Nasdaq Composite. He would watch the indexes in the same way he watched individual stocks, looking for signs of health or weakness. A healthy market, a confirmed uptrend, would begin when a major index rallied off a bottom and then followed through on the fourth day of the rally, or later with a massive spike in volume. This follow-through day was his signal that a new primary uptrend was underway and that it was now safe to begin buying leading stocks that were breaking out of sound bases. Once the uptrend was confirmed, he would monitor its health on a daily basis using a proprietary tool, the counting of accumulation and distribution days. As we discussed, an accumulation day is a day where the index closes higher on increased volume, a sign of institutional buying. A distribution day is a day where the index closes lower on increased volume, a sign of institutional selling. In a healthy uptrend, there will be more accumulation days than distribution days. However, when O'Neill began to see a cluster of distribution days within a short period, typically 5 or 6 distribution days over a 4 to 5 week period, he viewed it as a major warning sign that the market was under distribution. This was his signal that the composite man was beginning to sell and that the market was topping out. This counting of distribution days was his primary tool for anticipating a new bear market and taking defensive action before the major decline began. The M dictates the investor's overall posture. In a confirmed uptrend, one can be fully invested. When the market shows signs of topping, the investor should start selling their weakest stocks and raising cash. And in a confirmed downtrend, the investor should be primarily in cash or potentially shorting the market, waiting patiently for the next follow-through day to signal the start of a new bull cycle. Finally, a complete system must not only tell you when to buy, but also when to sell. William O'Neill's sell rules were just as precise and disciplined as his buy rules. His entire philosophy was that all stocks are bad unless they go up in price. There was no room for emotional attachment. He had several key sell rules for both cutting losses and taking profits. The single most important rule in his entire system was his 7 to 8% stop-loss rule. Any stock that dropped 7 to 8% below the initial purchase price was to be sold immediately, with no questions asked and no exceptions made. This was his iron-clad law for capital preservation, designed to prevent the small, inevitable losses from ever turning into catastrophic ones. His profit-taking rules were more nuanced. His general rule of thumb was to sell a stock after it had appreciated by 20 to 25%. He believed that this was a substantial and highly satisfactory return, and he was content to capture it and move on to the next opportunity. However, he made one crucial exception to this rule. If a stock was so powerful that it surged by more than 20% in the first 3 weeks after its initial breakout, he identified it as a potential superstock, one of the true market leaders capable of a much larger move. For these exceptional stocks, his rule was to hold the position for at least 8 weeks, and then to continue holding it as long as it did not show any major signs of topping. The signs he looked for were climax top signals, such as the day with the largest price spread of the entire advance or the day of the highest volume, which signaled exhaustion. He would also sell if the stock decisively broke a key technical support level, such as its 50-day moving average, a clear sign that the trend was broken. This complete multi-layered set of sell rules is what ensured that his system not only generated winning ideas, but also protected both capital and profits with ruthless efficiency. The first step in building a successful system is building the habit of disciplined study. The philosophy of William O'Neill is not an abstract theory. It is a set of principles that requires reinforcement. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the CANSLIM system is a holistic and empirically derived methodology that stands as one of the great achievements in the history of market analysis. William O'Neill's legacy is that of a scientist who, through decades of meticulous historical research, deconstructed the DNA of the market's greatest winning stocks. He did not offer a simple tip or a magical indicator. He provided a complete, interlocking framework that gives an investor a set of rules for every single decision they must make: what to buy, and when to sell. It is a powerful synthesis of rigorous fundamental analysis and precise technical timing, a system that demands discipline, rewards research, and forces the investor to align themselves with the market's most powerful and dynamic leading companies. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.